Hi, welcome back. Previously, we have covered the three financial statements, and in each financial statements, you would have seen different factors and components that build up each statement. And in the coming chapters, we will use the three financial statements to derive different ratios, and these ratios are used to evaluate companies from different perspectives. So to start with, we are looking at liquidity ratios. But before we proceed further, here's an example. Think about a blood test that you will do or have done. So blood tests are typically done to identify, monitor, and recognize certain signs and symptoms from your body. For example, cholesterol ratio, blood plasma ratio. So these different ratios will give you an indication of how healthy or unhealthy you are. So financial ratios works similarly. So it gives you a perspective of how healthy or unhealthy the company is, and it gives you a good evaluation to make good investment decisions. Financial ratios. So we use values from three statements to give insights about a company. So as mentioned, you have seen different factors and components in each statement. So we'll use those values to derive different financial ratios. And really, we just want to use those financial ratios to indicate liquidity, profitability, and valuation. So at the end of the day, it gives you a decision or an insight to whether or not to invest or not to invest. So we use financial ratios for investment decision making. Before we go any further, I just want you to take note on the top right corner of each slide moving forward, you would see a green box with an arrow pointing upwards or downwards. So if the arrow is pointing upwards, so for that ratio, the higher the number or the value, the better it is. And if it's pointing downwards, the lower the value, the better it is. So the first liquidity ratio we want to look at is the current ratio. The formula, very simply, is to take current assets divided by current liabilities, and these two numbers can be found on the balance sheet. So in this example, 250 million divided by 125 million, you will get a current ratio of 2. So what does this mean? So current ratio is to measure the company's ability to pay short-term or less than 12 months dues. So if the current ratio is 2, it means that today, if the company liquidates all the current assets that they have, they could pay 2 times of the current liabilities that they have. So the higher the number, the better it is. So at times of economic uncertainties or like a virus breakout, for instance, you need to have a very good current ratio to accommodate all the short-term deals that you have. In case that you have no cash flowing into the company, you can still sustain your business. In an example, think about being a fruit stall owner. So to derive the current ratio, let's say you have $1,000 worth of apples and $1,000 worth in cash. So these two are your current assets. So technically, say for instance, you owe your farmer $500 as the cost to purchase the apple. So your current liabilities is 500. So if you take 2,000 divided by 500, your current ratio is 4. So remember, the higher, the better it is for current ratio. The second liquidity ratio we want to look at is the quick ratio. By formula, you are taking the current assets minus inventories, divide by current liabilities. Inventories, by nature, is part of current assets. So you're taking current assets minus inventory and you are left with the liquid assets. So for instance, if there is 250 million in current assets, you have 50 million in inventories, you have 125 million in current liabilities. If you plug that into the formula, you will get a quick ratio of 1.6. So really, the quick ratio is to measure the company's ability to pay short-term, less than 12 months dues with liquid assets only. So it's quite similar to the current ratio, just that you are taking out the inventory portion and only taking in account liquid assets. So if you look at the top right corner, it's a green box with an arrow pointing upwards. So the higher the quick ratio, the better it is. In the example of being a fruit store owner, let's say we have $1,000 worth of apples, we have $1,000 worth of cash, and we have $1,000 worth of receivables. So receivables again is the sales that you have done, but you have yet to receive the money from your customer. You owe your farmer $1,000. So for this instance, your total current assets is $3,000. You take off $1,000 worth of apples in inventory. You divide that by 1,000, and you will get a quick ratio of 2. So remember, the higher the number, the better it is for quick ratios. The next liquidity ratio, the third one we are looking at, is cash ratio. So if we look at the formula, we are taking cash and cash equivalents divided by current liabilities. Cash and cash equivalents, just a reminder, is also a kind of current assets. And all these values you could derive or get it from the balance sheet. So assuming that you have a cash and cash equivalent of 60 million and you have a current liabilities of 15 million, you plug that number into the formula, you will get a cash ratio of 4. So this is to measure the company's ability to pay short-term, less than 12 months dues with cash and cash equivalents only. If you remember current, quick, and cash ratio, you are taking all the different kinds of current assets, dividing it by the current liabilities. So if you look at the top right corner, the arrow is pointing upwards. So this means that if the cash ratio for the company is higher, then the better it is. Think about the fruit store owner again. To measure cash ratio, you have $1,000 of apples and you have $1,000 worth in cash. So you have $2,000 worth of current assets. You only account for the cash. You owe your farmer $500. So it's 1,000 divided by 500, and your cash ratio is 2. In this slide, I would like to quickly show the difference between current, quick, and cash ratio. So current assets are divided to different components. For instance, you have cash and cash equivalents. You have the account receivables. You have other current assets. And you have inventories. So when we measure current ratio, we are taking the total current assets divided by total current liabilities. For quick ratio, we are removing inventories, dividing by current liabilities. So quick ratio is to assume that inventories can't be sold in short term, but there are other assets that you can liquidate fairly quickly. Lastly is the cash ratio that only accounts for cash and cash equivalents divided by current liabilities. So all these 3 financial ratios is a way to measure how liquid the company is to liquidate to meet short-term liabilities. The fourth liquidity ratio we want to look at is what we call gearing ratio, or in some places you would see that it's known as debt to equity ratio. So the formula is simple. Take the total debt from the balance sheet under the liabilities part and you divide it by total equity and you will get a ratio, or what we call the gearing ratio. So to calculate equity, you take total assets minus total liabilities, or it's easily found in the balance sheet as well. In this example, 250 million in total debt divided by a billion in total equity multiplied by 100%, you will get 25%. So when we talk about 25% gearing ratio, we are saying that the company has 25% of leverage over its total equity. So the measurement is simple. We want to measure how leveraged the company is, or simply how much the company has borrowed. On the top right corner, you will see the arrow pointing downwards. So technically, the lower the gearing ratio, the safer or less risky the company is. But nonetheless, you would see certain industries or certain companies that will always have high gearing ratio because that's the nature of their business. They always need to borrow money to build properties, for instance, like property developers. So they will always have high gearing ratios. In the example of a fruit stall owner, let's say the fruit stall owner has $10,000 worth of equity. So taking all the assets he has minus all the liabilities he has. If you owe the farmer $500 and $1,500 for stall rental, so that's your total debt, so to say, then you will have a gearing ratio of 20%. So you're taking $2,000 of total debt, divide by $10,000 of equity, and you will have a gearing ratio of 20%. So generally, the lower the value or the percentage, the better it is. To wrap up this chapter, a quick refresher. This chapter we have spoke about liquidity ratios. So these are ratios to measure how liquid the company is. We have 4: current ratio, quick ratio, cash ratio. So these three are taking the current assets over current liabilities to measure how much the company can pay their short-term dues. And lastly, we covered gearing ratio, which is just to represent overall how much the company is in debt or how leveraged the company is. We will have a simple checklist later on to point out which ratios are important or the key ones to go to when you evaluate a company. But for now, you have learned 4 liquidity ratios. So practice, look at different balance sheets to, sort of understand how liquid or how financially stable, if you want to put it that way, a company is. Thank you, and we'll speak again soon.